Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We have a debt ceiling deal, it seems. Congress hasn't voted on it yet, but over the holiday weekend here, it looks like we've come up with the outlines, and it looks like we're going to get to voting on it this week. So naturally, the question that ought to be on everybody's mind, I think, and is certainly on mine, is, are we okay now? Is everything all good? Is it all clear? We don't have a banking crisis that's spiraling out of control, at least as of today. We seemingly have at least the outlines of a resolution on what has been the other big tail risk. So is everything all good? Well, not so fast. It's not quite all roses here, it would seem. As we get to the other side of these risks and evaluate where we are in the macro environment as a whole. So what we'll do here is we'll kind of set the stage. We'll take a look at why the response to this debt ceiling resolution has taken the form that it has, why it has shaped speculation the way that it has, and then get a sense for what might be next in these coming days as the markets find what their next object of speculation is going to be. So first, let's talk about why the debt ceiling situation has worked the way it has and what all of it then means from that perspective. So the first thing to consider is, what was it that people were speculating on? Because I think there's a lot of narrative out there that what the question was with this debt ceiling situation was whether the U.S. was going to default or not. And in my mind, that's not at all what the question was for investors. Maybe that was the question for the news media, maybe for the general public. But from the market perspective, the notion of a U.S. default is a fairly ludicrous one. First off, in order to default, one has to not be able to pay one's debts. And of course, that's never in question, or was never in question in the U.S. The larger issue seemed to be something entirely otherwise. So consider the U.S. dollar, and we've looked at this chart before, of course. This is from the Bank of International Settlements. The U.S. dollar is crushingly dominant in terms of its share of global monetary turnover. There is just not a question whatsoever that this is the dominant medium of global exchange. I highlighted the BRICS currencies together here as a group just so we can see the extent to which the turnover there is a pittance, even compared to something like the euro, never mind the U.S. dollar. The size of U.S. markets is crushingly dominant as relative to other economies, even groups of economies. And again, I've put the BRICS here as a grouping so that we can see the overall sort of collective heft here. And I want to stress that all we're looking at here are stock and bond markets, and that's actually a bit of a handicap for the U.S. because, of course, the U.S. has tremendously developed derivative markets too, and others that other countries and other currency denominations simply don't have. So to use only stock and bond markets is really to level the playing field against the U.S.'s dominance. And still we get the kind of overwhelming U.S. skew that we are looking at here. And finally, this is how much external debt the U.S. has. So debt owned by entities and people outside of the U.S. And you can see, of course, the U.S. is dominant here as well. Now, this might look like a weakness, but it's actually anything but. Because the counterparty to all of this debt does not want it to go to zero. The U.S. is sitting on an enormous pile of external debt, but that, of course, means that on the other side of that debt is an enormous amount of creditors that have this exposure. So, in a U.S. default, where the currency powering all of this, and the debt powering all of this, basically goes to zero because the faith and credit of the U.S. government that underpins all of these things essentially collapses. Well, that's not any market that any of us would recognize. There is no level of the S&P that's the right level to price in, or the level of the dollar that's the right level to price in, or the right level of yields to price in for an environment in which the fundamental pillars of the markets as we know them cease to exist. And you can see them here. There is just no question that the global economy is intrinsically built upon faith in the creditworthiness of the U.S. government, backed by nothing other than fiat. Without that, there is simply not the existence of the markets as we know them today. And so, because this is the state of affairs, the speculation that was happening on the U.S. debt limit situation really was about fiscal headwind. What would a deal on the debt limit do to decrease spending, maybe increase taxes? And would a deal get done in time, or would there have to be a period where there was a pause in some spending, which would need to essentially be on the sidelines until a deal were done? It looks like over the course of May, markets have discounted all of those risks to some extent. So they've reduced the risk that there would be a significant fiscal headwind from either an aggressive tax hike or an aggressive spending cut or a disruption in government spending that ends up hitting economic growth in an outsized way. And we can see that here. The upshot has been that rate cut expectations have been reduced. The logic being, if there isn't a meaningful fiscal drag, then the Fed doesn't need to start cutting rates in a hurry. Then we are still, broadly speaking, in inflation fighting mode. And what we see here then is the outlook for rates by the end of this year. The red line is the December 2023 implied rate in Fed funds futures. That's been going higher all month. And as you can see, the gap between it and the June contract, so essentially where we think rates are going to be next month, that's been narrowing, and you can see that in the gray bars on the bottom. So you can see that at the beginning of May, we were looking at the idea of perhaps between 175 basis points in cuts in the second half of this year. Now we're looking at, on net, perhaps one at negative 25 basis points on the spread there. So the net influence of this debt ceiling conversation has not been about an actual default, because that's not anything that was ever in the cards, really. It's more about how much fiscal austerity or fiscal tightening the Fed would need to offset. And it looks like it's needed to offset less, given how this has developed. The impact in markets has been very telling. So even as rate hike expectations, or at least rate cut expectations, have been shifting to a more hawkish setting, you can see that in the red line there, stocks have actually moved higher, which is a bit different from what we saw, for example, back in February, where the conversation was the Fed has to do much more tightening. That red line was running up and stocks were going lower, because what that signaled was a higher hurdle rate on investment, a higher financing cost to fund economic activity. And so not surprisingly, companies faced with that would have perhaps an issue generating earnings. It would become more difficult to pay for growth, and not surprisingly, then risk came off. Stocks went down. This latest rebuild looks very different in that stocks are going up, and that, I think, is that improving confidence in that a fiscal drag of substance might be averted. Interestingly, the US dollar has been going up at the same time. Notice again, very different from what we saw back in February, the last time there was a meaningful build in rate hike odds. We have the dollar going up, but stocks going down. So at that point, stocks and the dollar were moving inversely. They are pointedly not doing that here. And so you do get this sense that maybe all is well, that we are seeing a broadly positive development in general, just because this fiscal risk is diminished. But how sustainable is this? And this, of course, is the key question going forward. If this continues, well, then indeed all is well. It is all clear. But how much scope is there for it to continue? Well, as of last Friday, we were, of course, again reminded by another round of inflation data that the fight is far from over. The yellow bars here are the 2-year break even. That's the bond market's expectation for where inflation is going to be in 2 years' time. That's right inside the Fed's outlook window. You can see it leads by about 2 months official CPI and PCE numbers, both measures of inflation. The PCE is the Fed's favorite. The CPI is the more common. We can see here they move generally in tandem. There's a little bit of a difference in them. And of course, on Friday, the PCE numbers came in with the latest set, giving us a year-on-year inflation rate at 4.4 as compared to 4.9 for CPI in the same period. So we can see here then that the break even is telling us that in 2 years' time, we're going to be at 2.1%. So basically on target for where the Fed wants to be going. We can also see that we are currently nowhere near there and are somewhere closer to 5%. So the question then becomes, well, how is it that over these next 2 years, we are going to squeeze about 3% more out of inflation? Now, the argument that there was lots to be done here in terms of reducing inflation by improving efficiency, by mending supply chains after COVID, that certainly was a part of this story, but it appears to be all but over. We can see here the Baltic exchange index, which is essentially a measure of global shipping costs, it's been going down really since the second half of 2021. And with some lag, it has shown up in a significant decline in the cost of distribution services. This is the cost of getting goods from where they are made to consumers, and indeed to moving goods around as they get finished. So in the red, you see the year-on-year growth rate in intermediate distributive services. So if, for example, we're talking about car manufacturing and some parts of it are made in Canada and some parts of it are made in the US and some parts of it are made abroad and some parts of it are made in Mexico, everything is moving around constantly until it's all finally assembled. It keeps moving as intermediate good from market to market to market. So the cost of all of that, as well as the cost of actually getting that final finished car from where it's finished onto a truck or onto a train or onto a ship and sent to where it will ultimately get sold, so the final distributive services costs, both of them have been sinking, as preceded by the Baltic Dry Index as a kind of leading indicator. And the growth rate there, just a hair above zero now, is right back to where it was before the COVID outbreak, and ostensibly even a little bit lower. So this part of it seems to have been squeezed out. Whatever inflation there was to pull out of the market in fixing supply chains, that seems done at this point. There doesn't seem to be a whole lot more disinflation that needs to get done there. Well, and then the question, of course, becomes, so how do you get these 3% in inflation out of the market then? Well, it seems like the cumulative impact of tightening gives us global slowdown as really the only way to keep moving. And you can see that here, the topping in inflation lining up with the top in global trade turnover. The light blue line there is the collective volume of global trade, both imports and exports added together to give a sort of sense of overall global economic activity. And you can see here, it's been going down right as inflation has turned lower. And so if we want to get this then to 2, and indeed if the markets believe that's where it's going, more of this is likely ahead. We can see in the latest set of PMI numbers, this is arguably why the manufacturing PMI index has so thoroughly underperformed relative to services. We can see here, all of it has been trending lower. So since the post-COVID recovery from the beginning of 2021 onward, the overall trend in economic activity is down. Down for services, down for manufacturing, down for the catch-all composite index. But clearly services have been doing better. Manufacturing has been struggling more, and that struggle seems to be captured here. Services still perhaps benefiting from all kinds of pent-up demand, both after the pandemic, where consumption was mostly focused on goods, because of course people were locked in their houses and not really moving very far. And now there's been a broader reopening. People are moving around some more. Spending on experiences has understandably increased in this environment, and so services have been somewhat more supported. But looking at the latest set of consumer confidence numbers, those have already rolled over. In fact, the expectations index is the weakest of the bunch. So we can see that current conditions are already souring, but looking out 6 months, a year, consumers expect things to get worse, not better. So this outperformance for services does not seem durable. It seems like we're probably heading into a catch-up decline there as the squeeze continues. Now, the most immediate reflection of this, as we look at markets in this current situation, will be tomorrow's release of job openings data. And this is a critical input into figuring out how much more economic pain there is and whether we are on track to really see enough there that the markets remain on target and the Fed does get to its objective without getting any more aggressive. You can see here the expectation that we're going to come down to 9.4 million job openings. That would be the lowest since early 2021. Obviously, a significantly higher number still than the pre-COVID average of around 7. But nevertheless, a meaningful climb down from the peak at 12. Now, what this factors into is this part of inflation, as distinct from shipping and supply chains and all of those things that we were just looking at. The blue bars here represent the gap between supply and demand for labor. Labor supply, of course, is the current labor force as it exists. So this is the number of people that are either in work or looking. And then labor demand is the number of people in work plus job openings. And so you can see here that through the COVID period, the bars shoot up aggressively. So there's a lot more labor supply than there is demand because, of course, businesses are on lockdown. There's not a lot of demand. So you have a situation where there's a lot more people wanting to work than there is demand. As you get economic reopening coupled with eye-watering levels of stimulus, I mean, we're talking about the largest fiscal stimulus we've seen since World War II in the U.S. as relative to GDP. Never mind in absolute terms. In absolute terms, the numbers are even more huge. But even in relative terms, just huge amounts of stimulus, and we can see the impact. There has been a full flip in the direction of labor supply versus demand. We can now see there is a ton more demand than there is supply. So the blue bars have completely flipped negative. So the number of people that are working or that want to be hired, job openings, vastly outstrips still the number of people that are in the labor force. And so what we can see here is, of course, when this is the case, how do businesses compete? They have to offer higher wages. If labor is scarce and businesses want that labor, how are they going to get it? The only way to compete is on price, as it is with really anything else. And that, of course, gives us high wage growth, which, of course, then factors into inflation by making the cost of doing business higher. If you have to pay more for labor, well, that invariably shows up in the price of the goods that you then sell or services, whichever it is. Most of the economy obviously employed in the service sector. And we can see that remains buoyant for now. Though, as we've just looked at, that may not hold out. And so what we can see here is the path then to less inflation, which you can see builds as the supply demand balance flips from surplus to deficit and narrows as the deficit narrows. The path to disinflation seems to be through the reshuffling of the labor market to a lower cost structure, which then necessarily needs a reshuffling of the supply-demand story. Now, for now, it appears the markets believe that this is going to work, that there's going to be enough economic weakness that the Fed has already engineered to get this done, which is how the break-even is at 2%. And you can see here the next number here, the one implied by where we would be if this 9.4 million forecast on JOLTS were correct. That's that red bar at the end there. It would be a little changed from the March bar and generally giving us the lowest shortfall since about September of 2021. So we can see the squeeze occurring. But if we're going to get from 5 to 2, there's much more of that squeeze ahead. What complicates the situation is that U.S. economic data seems to have started to perform better relative to expectations. It seems to have come off the bottom, as we surmised last week when we were looking at what might happen with the PCE numbers. It seems to have actually broken its 20-day moving average, which is about a month worth of time, 4 weeks at 5 days each. And maybe there is now a trend toward better U.S. economic data. Maybe some of these economists' models that go into figuring out what the median path for U.S. economic data is, maybe they've been more pessimistic than the reality has warranted in a more lasting way. In which case, might get a run of better economic data, which, like it did in February, you can see that here, starts to build more Fed rate hike odds. Now, for now, we can see that the situation has been relatively benign. So you can see as rate expectations have been going up, rate cuts have been falling out of the forecast because this debt ceiling thing seems to be less of a fiscal risk than it was feared. The break even hasn't moved much. It's come up a bit from about 1.9 to about 2.1, but it hasn't moved aggressively, largely because it seems like the markets are still convinced that the amount of tightening already in the pipe is enough to get us there. But if economic data like these JOLTS numbers start to perform better than expected, if there's follow through on this, in other words, well, then this gap might not close nearly as fast. And if that's the case, well, the Fed might need to do still more. In which case, we might once again find ourselves in the scenario that we saw in February, which is policy expectations keep building, and without this tail risk lens on fiscal policy, when that is simply just the Fed moving to contain inflation. If we start to see that with the building of economic data, we get that green line, that break-even line moving higher in a more meaningful way, and we find ourselves back at more uncomfortable levels, approaching 3, as we did back in the first quarter, well, then we might start performing like we did in the first quarter also, which would amount to weaker stocks as rate hike expectations rise, and probably still more dollar strength as that yield advantage is factored in. And that is Macro Money for today. Thank you very much for joining me. I am here as ever Monday through Thursday, right after overtime, which is our daily wrap-up show that I do with Chris Vecchio, head of Futures and Forex here at tastylive. I'm also on with Chris for Futures Power Hour on Fridays, and on with Tom and Tony for First Call on Sunday evenings. Outside those shows, I'm opining on Twitter at Elias Pivac. Thanks very much for joining me, folks. See you tomorrow.